Hey Chicken Gang, after I posted this on Twitter, on an option position I took, there were plenty of messages coming in. I do read your messages. This position instantly put $6,200 in my pocket, and I'm sure Tesla will become one of the most valuable companies in the world. However, we know that Tesla stock is kind of like extended. Tesla is at some sort of consolidation phase now, which is very good. This is the best time to dollar cost average. The longer the consolidation, it will act like a spring ready to bounce. Since Tesla stock is sideways, there is more than one way to profit from the stock market. We can profit from a sideways market too. Can you imagine my position I took on Friday gave me 7.8% returns in just 1 month? This video is for both beginners and advanced in options. Those with advanced options knowledge, I will do a quick FAQ for you at the end of the video if you think your strategy is better. If you appreciate such videos, I do appreciate an early thumbs up, it helps a lot. Some of you may know I used to teach options like donkey years ago. I stopped due to some difficulties in my life. I miss speaking on stage, and hopefully one day after this whole pandemic, I hope to hold one big event to speak to you guys personally. I'm not too sure if it will happen because probably I'll start traveling the world. I'm going to talk a little slower. This strategy I'm teaching is called selling at the money put. There is a science to this madness. It's about maximizing time decay to profit in a sideways market, a bullish market, or a bearish market. I want you guys to think of options as insurance papers. Insurance companies sell you this piece of paper, and that's all they do to earn billions of dollars. So think about it. So now you are the insurance company. Let me explain. In the options world, you can be the insurance company. There is no difference. You do this by selling puts and collecting money. So by selling puts, you are essentially agreeing to buy the stock at a certain price if it drops. Just like an insurance company, if you get into an accident, the insurance company will pay out the money. In the options world, there are many prices you can choose to insure. These prices are called strike prices. This looks complicated, but actually it's simple. Let's say I decide to choose a $815 strike price. This means if the price drops below $815 at expiry, I will buy the stock from you. You will buy the stock at $815. In taking on the risk, it's just like an insurance company. You will be given $60. Because every options contract is 100 shares, is $60 times 100 equals to $6,000 per month. Let me demonstrate. We are selling puts, so we are looking at the put section. Under the puts, you go to the agreed price or the strike price you want to sell. You click on it. This is one contract. One contract is 100 stocks, and you can adjust your bid and ask price. This is the same as buying stocks. When you click confirm and send, on this case, I will receive $6,000 in my account the moment this contract is being filled. It is that simple. Two things can happen. The stock ends up at $815 at the end of the contract, and you walk away with $6,000 just like an insurance company. Nothing happens. If the stock ends up below $815 at the end of the contract, you will buy the shares at $815. Remember, you collected $60 initially just like an insurance company. So effectively, your cost basis is $815 minus $60 equals to $755. This is quite cheap, right? $755 is your break even. Any stock price above $755 is pure profit. There are many dates of options to choose. You could choose 19 March, 16 April, 21 May. There is even 17 March 2023. These dates are third Friday of the month. So why did I choose 19 March? This strategy involves collecting the maximum amount of time decay. You notice 30 days I get paid $60, but 60 days, which is twice the wait time, I get paid $80. Twice the wait time, but only $20 more. Options decay faster during the last 30 days. The whole point of this very simple and extremely powerful strategy is to maximize time decay month after month, and you use it to your advantage. And you repeat this process every other month. I will be posting on Twitter on my options position, as it's much faster and it helps you understand better. Some of you who have experience in options, you will be asking why not sell a put at 700 strike collecting $20. If Tesla stock drops to $700, you'll be still safe. I also see some of you selling 500 strikes at $6. Yes, you can go so low, but do remember you are collecting only $6. Let's say you do this for a year. It's $6 times 12 months equals to $72. What if one day Tesla have a 50% correction? It's going to wipe out all your gains. However, if I'm collecting $60 every month for a year, that is $60 times 12 months equals to $720 buffer. Effectively, your stocks becomes free. You know, I always use this phrase. What seems safe is not often safe. Do watch my video on certainty if you haven't. I'll link it up here and down below. Personally, it's still one of my favorite videos because that mindset is going to massively change your life. So imagine doing this for just 2 months. It's $60 times 2, which is $120. You have a $120 buffer for Tesla stock. And that's crazy, and that's 2 months. This strategy has its downsides. If Tesla stock surge to $2,000 in a month, you will miss the upsides. But what are the chances? Your maximum profit is $60 per month. Because of this, you should hold mainly stocks and use this as a cash flow strategy. It's pretty good cash flow. You take the money received, which is $60, divide by $815, is 7.3% returns per month. A month! Do remember, each contract is 100 stocks, so $815 times 100 is $81,500 per contract you need to set aside. I do not recommend leverage, but if you really want to, you need to position yourself to tank a huge market drop. There is still plenty to learn in options. I'm just covering one of the many out there. This strategy you just learned, many options experts don't teach the way I do. I pioneered a few different strategies like years ago, and you just got a taste of how powerful it is. For the advanced option users, this slide is for you. Why not spreads and hedges? If you buy put to protect your downside, you are not maximizing time decay and you're actually paying for it. And that's the same goes for hedging. You burn money every month just to hedge. Stock market goes up most of the time and you'll be probably burning all the time. Covered calls is a strategy that I avoid. It sounds awesome in theory, but it doesn't work for me. I buy stocks to 10x. If you put a cap on the upside of the 10x stock, I assure you this, out of the 99 covered calls you sold, I assure you when the stock shoots up, you will never be able to roll yourself out of the trade and goodbye stocks. Wrapping up, most people think that money is hard to come by. When you understand the tools, money comes pretty easy. The only difference is the knowledge gap, and I'm here to level the playing field. My goal is to help you, and hopefully you help others the right way. I think about how powerful this strategy is, like 7% a month. Oh, it sounds so stupid you think that I'm selling you a dream. I will be updating my options move monthly on Twitter to help you understand better. I hope this video is time well spent for you. I appreciate the thumbs up for all the causes I believe in. And as always, you know what I'm going to say, invest safe.